Oh, he's coming.
Oh, we're waiting. We're waiting
It's almost
patiently.
time. It's almost time. We're gonna get a lot of cool info coming out at 2. So for you guys that don't know yet, that may just be a little bit confused about the schedule. So we're basically getting that summary of economic projections at 2, and then at 2:30 we're going to be getting the press conference with Powell. That is going to be where the biggest move happens most likely, cuz he's going to go through that question and answer section, and he's kind of
Dig
on
a
the
hole
hot
for
seat here.
himself. Dig a hole for himself.
Mhm.
Oh boy, oh boy. Uh Ryan. Oh, that's right. We gotta is Ryan a good trustworthy mod? He says he
He is.
wants to be
Ryan
a
is a
mod.
very trustworthy mod.
Okay. So let me make him a mod here then.
Let's do it, man. Dude,
In
this is going
case
to be a
things get like
wild,
really
wild
spicy.
time.
In case things get spicy here.
It could, you never
Ryan.
know. Powell likes to bring out the spice in everybody. Uh, let's do this thing, man. All right, people. Again, this is a public stream too, so make sure you guys engage with the video. Hit that like button down below. But what were you guys trading today? Did anybody get into anything spicy? I know Lucid was screwing around for a bit. Everybody was hunting for that Lucid rejection this morning. I was in a little bit on coin, stopped out on Baba, and then nailed Spy. So other than that, I haven't really done much. After I hit that SPY trade, I was like, just burn it until Powell. Just burn it.
It's gonna be interesting. So all right, guys, let's run a little poll here. Are we getting 50, 75, or 100? Let us know in the comments where we're going with this. How
Let's
hawkish is Powell really going to be?
He has enough room to be hawkish. He has a little bit of wiggle room, in my opinion, to come out with some pretty crazy statements, just the way that the job market
Mhm.
is right now. If he
Yeah.
goes really crazy, you're gonna see the Atlanta Fed either next week or the week after potentially signal for another negative GDP print. It's possible. They've moved their projection from the height of 2.6% growth in Q3 all the way down now to about 0.3%. So we will see. Like,
Yeah, we got contractions in the economy, but it
mhm.
ain't giving birth to anything. I tell you that much.
No, nothing good. The other
You
thing
know,
that I'm gonna talk about a lot later too. We got about 4 minutes. Is Tina? There is no alternative. So when you think about how the market has been reacting to basically the relationship between the equity and bond market over like the last basically 10 years, there's been a phenomenon of there is no alternative. So thinking about the stock and bond market, bond yields have been really low for like the last 10 years. Why would you put your money in the bond market? It makes more sense to go out and take the risk in the equity market. Now though, with bond yields starting to tick back up to pretty high levels, I believe I'd have to look at this to make sure. This is what I have to do a little bit later. I believe they're getting either very close or above the S&P's dividend, which that creates a very weird scenario where if you're going to see a lot of market turbulence and volatility, you might just see people start to buy bonds and say, fuck it, I'm just going to go into the bond market. So that may
yes.
not seem like a big deal, but if you think about the flow of money, money goes out of stocks, so more supply, less demand, and into bonds, less supply. Well, taking out some of the supply and more demand, which can balance out some of these yields when you see a lot of money flow into this. It may not
Yes.
happen right now, but that's kind of where we're headed.
All right. So we don't start seeing a recovery till mid to late 2023. Is that a fair guesstimation?
I think so. I was actually looking at I was looking at the probability tools, the Fed Watch tool last night. Um, And they were actually pricing in if everything went according to what the market thinks, I believe it was by July of next year, they were pricing in slight rate cuts. So they would raise rates and then slowly start to bring them down. I'll be very interested to see how those probabilities move after what Powell says, especially with the projected terminal rate that we're going to get in this report that's coming out in 2 minutes.
Interesting. Interesting. So the Treasury 2-year yield is hits a milestone today.
Hmm.
Just going through Bloomberg here and just trying to find that yield.
Yeah, I think
As
it's the highest it's been since 2007.
2007.
Hmm.
Emotional damage, ladies and gentlemen.
Oh yeah.
Emotional damage.
Yeah, the dollar's super high too. You see, Putin did a little bit of escalation this morning too. We can talk about that too, maybe a little later. But he's basically mobilizing about 300,000 troops from basically like their national guard. But he was also offering like convicted like felons the ability to have like freedom if they serve in the military for 6 months. So it was kind of like a desperation move where they didn't really need to do it. There could be a lot of propaganda nonsense going on with what Putin's saying. You saw Lockheed move this morning, the oil, natural gas. A lot of things were starting to move a little bit strangely.
Wow. You know that there's some hardened men up there in Siberia. If you want to go ahead and enlist those guys, because
Yeah.
that's where they send the baddies over in Russia. Like it's not habitable, pretty
No,
much.
it is cold. It is cold. You would not
It
do
is
well there,
rough up
Mister
there.
Mister Warm Weather.
Oh man. Well, hey,
Yep.
look it's 68 in my studio. I got to keep things cool here. Otherwise, my electronics start overheating and shutting down.
That's what my
So,
camera used to do all the time.
yeah, you got
Oh,
to
here we go.
lower your temps. Ooh. That's what we want to see.
So we
That's
got a
what we want to see.
75 basis point hike.
75 basis point hike. Not that bad. Now, let's go ahead and watch the spy. You're watching the spy in real time. Let's get it, ladies and gents, because now the spy just had total disregard
Ooh,
for the 200 EMA.
ooh,
SPY is now making its move down. There's a level of support currently at 382.80, but this is this is going to be fun, boys and girls.
ooh, here we
This
go.
is
This is
going to
interesting.
be fun.
Uh, Fed officials see Fed's funds rate at a median of 4.4% at the end of 2022.
4.4.
Median forecast shows rates of 4.6 in 23 and 3.9 in 24. Oh, this
That
thing's
is
getting
wicked. That is wicked.
this move down was that how many points was that move? Three $5?
Yeah, that's a $5 move.
Jesus.
That's a $5 move.
This is nutty.
Holy. Right. What would be interesting to see is if buyers step in. Well, they are right now.
Yeah, they are. Or they're trying
They are.
to.
They're trying. They're trying. Now we're looking at the RSI here. We got to put signal, and we're looking at the RSI immediately. Remember physics? That's called gravity, and that's called
Yep.
a free fall. Currently, RSI RSI is at 28.73, 31.29. Yeah, they're fighting back. They're fighting back. MACD just took a nosedive. Everything took a nosedive. So what I want to do is pay very close attention to the ADX. Now, the ADX is going to give us an idea of the strength to the downside right now. All right.
Yeah.
And we're going to pay attention also to RSI, because RSI here on the 5 minute, anyways, we stay below I want to say we stay below 35, and you have a very, very strong trend continuation. So, guys, I don't know, dude. Okay, bets on. Does it get worse after Powell talks, or do you think it gets better when Powell talks?
Oh, I don't know. I don't know. That's gonna be a tough one to determine. It's he's I don't know. I don't it depends on how this Q&A session goes. Like, he could easily come out and just say, "Fuck it all," and just really, really start tanking things.
All right. Some are saying better, some are saying worse. I think when people talk and you're able to put context into things, and then you allow others to attempt to interpret what you're saying, then you get, you basically get a split, right? So
Yeah.
people will be half and half on this, on based on what he's saying. But investors are going to be investors, and so uh, yeah, this doesn't make anybody feel good right now. And
No,
what I want to
it
do is go.
doesn't.
What I want to do is let's go ahead and check out Apple.
Oh,
And
that
just
thing
really,
probably got
oh, there you go,
mollywopped.
die. All right, Tesla, death. AMD,
Death.
death. Ford, only because there you go, you got some death there. Target, death. We're seeing we're seeing death everywhere. Should I do it? STV, should I?
You
Should
going for
I?
target death?
Should I? Should
I
I?
don't know. I don't know,
I want to.
maybe.
Well, should I
Oh,
click this?
uh-oh,
Oh,
uh-oh, that's not
uh
gonna be a good one. Oh boy.
death.
More death.
More death. It's guys. This is just mass. This is massive. All right. Here we go. All right, back to the spy. Let's check out the Neos and the Lucids, and yeah, money's being dumped everywhere. There you go. It's put season, ladies and gentlemen. It is put season.
Oh, yeah. This is getting filthy. Let's see if they push it to oh, they bounced it off 380 there a little bit. 380.26,
Okay.
they bounced it.
380.26. You got the bounce there. Well, that was a level that needed to be protected.
Yep.
I mean, it was a level. So, huh. Let's see here.
If they
What do we
crack
do?
380 with this, that could be dirty.
If it does crack 380, do you think that RSI is still way oversold?
Ooh,
We're
yeah.
playing momentum right here, right? And ADX is showing some strength here. Currently, ADX, the value of ADX on this candle. Um, I mean, and mind you guys, uh, we're going to experience some whipsaws here, okay?
Yeah.
Some whipsaws here, but ADX showing 24.70. We break 25, guys. Yes, I like this trend. RSI still well. Oh man, RSI went subterranean at
Oh, boy.
23.75.
Dude, this is a filthy move here.
This really is. This really is. I bless you all and your calls. Um, So did you play? Did you play both ways today,
No,
STB?
no, I didn't play this movie. I thought it was gonna be a little bit of a crapshoot. I was like, "Nah, I don't know either way on this one. This one could be a dirty move." So I just kinda sat it out. I was like, we'll see what happens when Powell wants to come out and see if he wants to see if he gives any sort of indication. If you did have puts into this move, you're killing it. That was a massive move. Remember the IV, the implied volatility on this thing is pretty crazy right now. So I would
Yes.
almost wait a little bit until Powell starts to talk, but this is a filthy
Yeah.
move.
Yeah, it's pretty wild right now. Pretty wild right now. Uh, a lot of volatility. Hey guys, let us know if you're printing. Legendary's up 42% on Amazon.
Jeez.
Congratulations. That's what I
There he
like to
goes.
see. That's what I like to see. Uh, Stephen Roberts says, it was my phone. Was binging on auto sell. Okay. Thank you guys. I made 49% on puts on SPY. I was holding
Woo!
since this morning. $725. Congratulations.
That is awesome.
Hey. Yes. 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 And yes. 1348 gang. You guys are killing it. We talk about patience and how patience pays, and you guys were patient and you knew what was coming. You knew it was coming. And you know what? You secured the bag. You saw that level. You saw that blue pill line. That blue pill line was right there for you guys to see. You knew it. She came right back. She came right down to it. That's when you said, okay, I got more than I deserve.
Yep.
Congrats to you all.
You
For
guys did
those
great,
who
man.
are wondering about the chart and what we're covering and what's on the chart and how we explain the chart, you're new to the stream, new to the channel, make sure you go ahead and hit the subscribe button. Make sure you hit the like button. Actually really helps out the algorithms. I'm learning a lot from STB, sounding just like him. But with that being said, also check out the links in the description. You get a free copy of our charts. These charts are proven. They are goated. People are printing in our community. And charts, well, that's 90% of the battle. But what if you want actionable alerts? That's what you're going to find here at Trade 1348. This is why people print.
Mm-hmm.
Okay. So also check that link down in the description. What are you waiting for? It's time to make money. It's going to cost you a few coffees a day, but guess what? You'll be making more than that each and every day.
Mm-hmm.
I know there's some individuals right now in our community in the chat right now who've probably made 2 or 3 years worth of the monthly subscription just today. Pretty sure of it.
Yeah.
So
Yeah. I mean, we have like the day that we had people showing off all the cars that they were buying from 1348 and in the house. Like, you guys are killing it, man. Let's get in there, dude. This is retail winning every single day. Coming in there, taking control of our portfolios in the market. We're winning.
Tabasco Dave made 150% put side.
Woo!
Lost 50% call side on his strangle. Oh, he played it safe.
Strangles are the way to go in this market, man. I mean, the strangle would have printed pretty nicely here, but very risky to play.
It's risky business, but hey, look it. Don't come into the market expecting, it's going to be green, green every day. Well, that's unless you join our Discord, but I mean, it's green, green most of the time
Those
to
base
make
hits,
money.
man, they're all over the place. Those base hit trades are everywhere.
Yeah, yeah, yeah. And I'm actually going to distract from what the market's doing right now. I know you guys are hell of excited, made your money, but STV, I got a bone to pick for you. Pick with you,
Oh no.
right? How about those Sox? Are they even making the playoffs?
I
Come
don't
on,
know. I don't know. I don't know. I don't want to talk
all
about
right? Judge smacked the 60th home run.
it. I know. I know.
That man is a beast. He's a monster. He's a legend.
Maybe I'm gonna go to Yankee
Woo!
Stadium and just cause a scene. I'll have to pull a Fenway Park like I did when I was 12 and just go shit myself in the middle of Yankee Stadium. How about that? I'll leave my mark there.
How about this? How about this? Before you do some stupid shit like that, right? Just let us know so our company can go ahead and file your life insurance policy. Okay?
All right, cool. I will. I will.
I want to cash out on your fucking policy, man.
All
That
right.
that that's
All
a
right.
fact. Don't don't be that stupid.
All right. Oh man, dude, this day is crazy. This is fun. Let's see. How much time we got to Powell? I got it pulled up over here somewhere.
All right,
I hit
let's get it up there.
the hold on, it's gonna come through. Oh, there it is. Yeah, so 2:30 p.m. all loaded up here. We're gonna be getting Powell in a little bit. Spy's starting to make that move back down, and
Yes.
also fuck the Yankees. But
Yes. Oh man. Yeah, we all love this move. This move is I really want to see the break of 30, 80, 37 guys. We've been preparing you for this because it has been bouncing off this level all week. That's why we have it there for you. We have this there right for you. You see that wick? That wick flirted with 30, 380, 37. Just flirted.
Yeah.
I'm waiting for a committed candle. I'm waiting for a very committed candle for a reentry. Puts printed, you know exactly when the cross happened, candle comes down, you know exactly where to exit, guys. I'm so happy for you. You made so much money today. Now imagine if you went full port. No, no
No.
yellows here. We
No,
don't do
no, no, no,
yellows
no,
here.
no, 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 no.
No yellows.
Bad. None of that.
Oh
We will
my,
have
oh
none of
my.
that shit over here.
None of that. Oh my God. Coffee down the wrong throat.
Oh boy. Yeah, you gotta manage
Yeah.
the risk, people. Don't be full porting things. What are you that then it's like if you I don't even I'm guessing it's a joke, but people do it, and that's probably the most financially irresponsible thing that you could do.
You can. You know, the fallacy of the win.
Yep.
You know, there once was a time that even the Patriots won one game a year. They were that bad. I don't think you were alive to witness how horrible the New England Patriots were back
Yeah,
in the
well, they're good
90s.
now, and the Giants suck, so
All right, you know what? I got something for you to suck on.
okay. Oh my
Fucking
god.
Red Sox.
Oh, 110% on a SPY put, I'm done. Jesus, guys. 4.22% on the SPY. Nice, guys. Killing it over here. You
Right,
guys are
right,
doing
right.
great.
Ryan plays as super conservative. Ryan has been an OG, and Ryan is slowly but surely just getting it.
Yeah.
Right, Giants and Yankees fan right here. Yes, that's what we're talking about. But Ryan, I like his progress and I like his dedication, and I feel like that light bulb is bound to just go for him.
I think so too.
In Yeah, I think Ryan has the potential to be like like a major ambassador for the community. From zero to hero, that kind of thing. I'm not calling you a zero, Ryan. What I'm saying is that we pay attention to you and we're watching you like a hawk, kind of like Powell is
Mhm.
hawkish. All right. Took Nancy for 33%. Woo.
Not bad.
Uh, Not bad. Yeah, we got too many Ryans in this Discord. Yeah, we
So many
do. But
Ryans.
you guys know the Ryan we're talking about. The OGs know.
The
Get
OGs know.
familiar. Get familiar. Guys, welcome to the stream. We are going to simulcast Powell here.
Mhm.
We're going to talk about what he's saying, what the old man's saying. I mean, like, come on. It's really, really interesting to see old men talk about something that they're absolutely detached from. It's just really wild to me, right? Because they're not living it per se. Really think about it.
I think they're just so behind the curve. Like, they've just been so asleep at the wheel that there's not much that they can do now. It's just throw the kitchen sink at it and hope something sticks.
Yeah. Yeah. It's just hope something sticks. I mean, if we see a break below 380, that's where I'm getting really, really excited. The win wasn't the put for me. The win was, or the win is and still is, 380. Now, do we break that this afternoon, or does the market just sort of kind of give up and say, all right, tomorrow we die some more? Because the day after FOMC, the market tends to give up 2 to 3% on average. So
The day after is
we shall
pretty
see.
crazy. The day of, if
Yes.
you actually look at the day of the FOMC meetings over, like, the past, like, bunch of them, the SPY's been in the green. Like, you've seen that nonsense drop right off the bat, and then it starts to rip back up. So let's see what happens if it's gonna follow that trend, but I did see that chart getting floated around everywhere. The other thing
Yeah.
is that when everybody and their mother on Twitter starts to share a chart, it's usually time to inverse that entire thing. So, we'll see.
All right. So we got some good news here. If we go back to the chart, guys, I mean, this is where I'm building my confirmation here, right? this is where my confirmation and this is what I'm looking for, right? These are things that I'm looking for. I'm looking for that ADX to break 25, which in fact it has, right? Now, this looks like consolidation, but there's actually strength in this move, considering that 30, 37 is just a pain in the rear end, right? So everything is just is looking pretty. I'm waiting for Powell to talk, and I'm waiting for it to die some more. Then things will get interesting, guys.
Mm-hmm.
All right. Don't you dare full port calls at the bottom. I will ban you.
Those are some risky bets over there. Don't be going crazy, guys. Don't be going crazy.
Yeah. And for those who are wondering why we are playing the 5 and not the 1, it's because the 1 is hella noisy.
Yeah.
Okay. It's hella noisy. But as it stands, look at the MACD here on the 1 minute. Well below neutral. I mean, we're talking negative ones, negative 1.6 on the MACD and negative 1.13 on the signal. This is, yeah. You know what? This is actually not as volatile as the last FOMC. The last FOMC, it went full on rubber band.
Mm-hmm.
Um, I
It
feel like
hasn't
this
made
is more of a
that reversal move yet.
yeah. This feels like controlled chaos, if you will.
Yeah.
I kind of like it. I kind of
It's
like
almost
it.
just waiting for Powell.
Yes.
It's just kind of
They're
bracing
like,
for what he's gonna say. Well, okay, you know what he's gonna all right, here's what we're gonna do. This is gonna be fun. The first couple of sentences out of Powell's mouth, this is what I predict he's going to say. We at the Fed understand, so like something along these lines. We at the Fed understand the hardships that inflation has brought to the everyday American people. I think that's going to be within one of his first couple of sentences. He says that every time, and it's a lie every fucking time.
yes. Power talks in 10 minutes.
Oh, here we go. Yeah,
I'm
I
excited.
have the feed queued up right here.
Perfect.
We'll get that going in a little bit.
Perfect. Perfect.
Let's see.
All
Take
right.
shots at me.
Take shots every time he says that. You know what? We should make this a drinking game. Why not? It's 5 o'clock somewhere.
We could. We could bring back the power half hour from those night streams that we used to do. Those dude. We used to go
Yeah. I
crazy.
always keep the prop ready. You always got to have it ready.
I might be
Celebratory.
out of booze. I might have drank it all. It might be gone.
I don't think you should ever admit that, like publicly on a live stream. They will be gunning for you on Twitter, and they will blame me for it somehow. That
Oh,
I'm such a negative influence.
I'm a much more toned down degenerate now than I was. I did let it fly a little bit, but I think I don't know. I got to think of which tequila bottles I still have.
Yeah,
They always end up
yeah.
because the thing is they always end up at like my friend's house because I just go there and like just pregame there and I'm just like, well, I'm not drinking this, so I just leave it.
I got something for you.
Oh no, what's he got? DoorDash some? Oh boy. Oh boy. Yeah, I'm watching Spy Like a Hawk here. We could see something interesting here.
Time to take the market seriously. Let's go.
Elmo.
It's me, Elmo.
Dude.
Oh man, the good old days.
The good old days.
The good old days.
Jesus.
Photoshop.
I love those. Dude, the memes with the Elmo hat is hilarious. I love those. Oh,
Oh
okay. So
man.
also when we go to do Powell, you're gonna have I would say mute your mic because the way that I'm gonna do it is I put the mic right next to the speakers. So if you talk, it's just gonna echo like crazy.
Okay.
Let's see. Gonna start loading the memes. Oh, Tabasco Dave, the resident meme expert. I'm very. Let's see if I can pull up the.
All right. The question is who's got the balls to stay in the SPY put play?
See, I don't know about that one. Let me see. I'm seeing if I can find a link to it somewhere. I want the summary of the economic projections here. That's what I'm looking for. Come on. Is it this one? Nope. There's a notice that comes out. I'm looking for it. The last one was in June. It may not be that one. Okay. I'll look for that in a little bit. This is a very quiet. Honestly, this is a lot like we usually see the volatility in both directions. We were just. I think there's still another move coming off of Powell. I think there's another one coming.
You think there's another one coming?
I think there's another move that's about to happen.
Wait. Do you think there's a move down or a move up?
They might try to hold this thing at 380, depending on how hawkish Powell comes out. If he comes out like he did at Jackson Hole, it's going to be rough to the downside.
Oh, man. Uh-oh. We got memes in the Discord being posted.
Hold on.
I'm scared to look. I am scared to look.
Those are reckless.
Oh, my. Oh, my.
All-time high.
So, guys, you also have to remember what goes down must come up. So, if we are looking at it coming up, we want to be aware of this here. Let me show you. The 13. That 13 is your first line of defense. These candles here, let's actually put this. Yes, I like this, right? So there was a level that printed here pre-market, right? And you see 2 consecutive candles just literally being pinned in this range. This is going to be interesting. I am absolutely excited. I hope you guys are as well.
I think this could get interesting here. It's also right at where that 13 is on the 5-minute. It's right at one of my key levels.
Okay. I mean, we got some light pink on the histogram here.
On the 5?
Yes, sir.
This could get interesting here coming into Powell. Let's see if it tests. Starting to make a little move there. The buyers are trying.
Yeah.
Level I have it at 383.81. That's about where it is.
Okay. 381. Yeah. Let's see. Come on, Powell. Come on. Kill it some more. Kill it some more.
Here it comes. And you got the 48 on the 1-minute at 383.33 too. It could tap that, come right back down.
Yes, it could tap that. Now, okay, so now that we're on the 1-minute, it gives us an opportunity to illustrate something, right? So the levels that you saw printed on the 5-minute also transferred to the 1-minute, and it's fairly close to what we affectionately call in this Discord the blue pill line. You also have the 40A DMA, as STV noted. Now, here's the thing. Look at where, and we're on the 1-minute, okay? RSI just barely cracked 50, currently at 51.47, 50.67, just oscillating between 50 and 51. The thing is that the trend to the upside remains weak as long as the MACD and the signal line stays below neutral, which is 0.00. That's what you see this yellow line here, right? Now, we don't play the 1-minute, but I feel like the 1-minute is going to give us a little more precision in our entries and exits, especially with the kind of volatility we are expecting, especially when this man talks.
Yeah.
You know, he's going to say, I pooped, it dumps. He's going to say, I wiped, it runs. He's going to say, I'm divorced, it dumps. He's going to say, my side chick's 22, it runs. So, the market's
Yeah.
going to be very, very sensitive to everything this man's saying. So please be cautious.
Oh, yeah.
And I would say, yes, play it on the 1 minute. Play it on the 1 minute. You have RSI converging into its moving average right here. So this is exciting. This is exciting. We know that once our RSI breaks below its moving average, things get really spicy, and that's what we're waiting for. Guys, you are watching Proof of Concept here on the 1 minute. We're beginning to see some mint greens on the histogram here, which means that even the bulls are like, wait, there's 2 minutes before he talks.
Yeah. Everybody's getting scared right now for Powell.
Everybody. This is going to be interesting.
Yeah, we got 2 minutes to go here. It's teetering. It's just teetering. I don't know where the buyers haven't stepped in yet. We will see.
We will see. Guys, I would also go ahead, when you're considering your entries and exits, I would go ahead and set your orders like almost immediately, because this thing's going to move fast.
Yeah. All right.
So
Let's see. We got less than a minute to go here. Let's see if the buyers are going to step back up on this thing and pump it. I don't know. I honestly don't know what they're going to do with this thing here. This could be a dirty move.
Yeah. So right now, I'm looking at a possible. Let me see. It's my average. Okay.
Let's see. Buyers left for the summer. They aren't coming back. We'll see. All right, here we go. Gabe, you got your mic. Let's see.
All right. Let me go ahead and turn off your mic.
No. Just mute your mic.
Okay, I'll go ahead and mute my mic. Here we go.
Cool.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2%. Before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time, but we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Rachel. Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there is what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events. It remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that, I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings. And you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank
Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it. It's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening, but you're right. It's just, and we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward looking and the lags in your policy are forward looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth. And we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth. And then below trend next year, I think the median was 1.2, also well below. So that's a slower, that's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really are suffering from inflation, And if we want to set ourselves up, really, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation. And that's what we're doing. And we certainly don't hope, we certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion. And this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability. And I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much. And that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence from Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down significantly over the course of next year, and then more the next year after that. And, I think once you're on that path, that's a good thing. And things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy is improving. And also, if our projections are close to right, you will see that, that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs. And we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year anyway, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. That's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
Sure. So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you could pick and you get, but what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Oh my Lord. Welcome to Print City, team. Oh, look at those perfect levels right there. You see that? You see all those levels drawn out on the chart? Let's see.
You're welcome.
You're Mike.
You're welcome.
Mike?
It's on. It should be on.
Oh, wait.
Oh.
Oh, I can hear you. Sorry. That was me.
Yeah. There you go.
I'm being a dumbass. Oh my God. Welcome to Print City, team. Look at those levels, dude.
The levels are beautiful. Definitely bouncing through these levels. Now I want to go back to the 5-minute here. As I'm looking at this, this is not looking pretty at all on the 5-minute. I mean,
you got it. The 1 minute is where you can see it a little bit better on some of these Powell moves, but like this, the 5-minute just looks like it's having an absolute fucking disaster.
Yeah. And this is basically what I want to see. Again, it's RSI converging onto its moving average on the 5-minute. Again, the larger the time frame, the bigger the move, right?
Yeah.
So I'm really excited about that. We shall see. We shall see how the market reacts over the next 45 minutes.
A lot to unpack.
I don't think the market. Why does it feel like Powell was just literally like, I don't know, just using fucking footnotes? Like he said all this before. Like it sounds like a broken record. It's the same thing. Meeting after meeting after meeting. Like they do not have a clue as to what to do. Like really, they have no clue. They're stuck between a rock and a hard place. They can't overshoot the market for fear of like literally putting it in a recession. But it's like sometimes if you take more of like a pacifist mindset, you're actually doing more harm than good.
Yeah.
You know. I was looking for something a little more aggressive, and I was looking for us to try to hit the reset button as expeditiously as possible, because what you heard him say, a common theme, was that lower income families were going to feel the burden of this.
That's what we've been saying. It's like the credit card, like when that one guy asked the question, he's like, well, what's going to happen? It's like this, and this. And it's like all of the above. What are you asking about? Higher credit card rates, mortgage rates going up, home prices coming down. It's tougher to get loans for things. You're probably going to, the average hourly earnings is going to come down. You're going to be making less money. And if inflation doesn't come down, you're making less money. Things are still expensive. You're fucked. Like, it's not good.
I mean, it's really not good. And then considering that lower to middle class America that makes up the majority of our economy, if things don't bode well for them, I mean, unfortunately, we have to figure out a way to keep them propped up.
Mm-hmm.
I mean, the market, the market generally follows, right?
Mm-hmm.
But if you literally just like take out the legs of lower to middle income America, you choke out the economy.
Mm-hmm.
You literally choke out the economy. And I love what he says that Americans have some cash reserves. Essentially, that's what he's saying. Like, hey, got some savings there, but
that's going away. Like, imagine how quickly that gets depleted.
Yeah, because rent's too damn high. You guys remember that
Tell me
guy?
about it. Tell me about it.
You remember that guy, right? However, we don't have COVID to protect them. Remember, in COVID, well, you weren't working, you weren't making the money. COVID literally protected you and prevented your landlord from giving you the boot. You don't have that protection right now.
They pulled the safety net.
It's just so bad right now.
Mhm.
Just feels really, really bad. So then now the next question is okay, so how does so discretionary income goes out the fucking window. Interest rates go up, right? People begin to rely on their credit cards. Things get more expensive, right? Companies start raising their prices.
I think they lay
do the
people off
companies
first.
raise their price to offset, lower volume, for
I
instance?
think they lay people off first. We saw with Facebook today. What they're doing is Facebook doesn't have prices for things. It may be in terms of the advertising platform, but what they're doing is they're cutting a certain percentage of their workforce for another percentage increase in free cash flow. So they're just gonna try and keep their margins where they are. So they're just gonna start laying people off. We've seen it with a lot of companies so far. I would not be surprised if over these next 3 months it's just layoff, which is to be expected. The unemployment rate is going to go up with these rate hikes.
Yeah, I would. Yeah, unemployment's going to go up, and it just really sucks. It really sucks, but it doesn't matter. You know why? Because if you want to live life stress free, you have more than one source of income. And I'm pretty sure a lot of you here in our community, you have your primary source and you're using the market as a secondary source. And you're making your money, right? I really feel like, the ethos of what 1348 is really shining right now. Because with retail being biased to the bull side, and again, I hate quoting Jim Cramer, but he did say there will come a time where retail will get destroyed. And we're talking about these very times. So, I to 1348 gang, so proud of you guys. You guys printed. you
Alex, take
printed
a
with,
look at the gains. It's pretty ridiculous, man. I mean, you guys, again, it's 1348 is the core of learning how to trade, learning all of the levels, and incorporating all of the other things that we like to teach. You're gonna get taken far. You're gonna take it very far. If you think that all we're offering is simple crossover alerts, you are sadly mistaken. Our algorithms are crushing it. The live streams, the curriculum. I mean, that's what you guys are doing great. If you guys are interested, we call ourselves the best place to come and learn to trade. Come see why.
Come see why. Not and we're not just saying that casually. I'm saying that affirmatively.
Me too.
All right. We have created probably the strongest group of traders ever on a platform. And of course, I'm saying that with bias, but my conviction is very, very strong. Just seeing the growth of individuals in this community, seeing how they're multiplying their P&Ls, their portfolios, and seeing the P&Ls, and seeing the consistent daily gains, and seeing the adoption of the strategy and the mindset, the adoption of being a winner. No one should have to be at the mercy of the market. No one should have to be at the mercy of Powell or the Dems or the Republicans, or no one should have to be at the mercy of their job. Oh my, right? Your job say, hey, thank you for your service. Thank you for your 20 years. We got to let you go. We can't afford you. Right? It's just, that's the reality, right? So really, really proud of you guys. It was a lot of fun. I like to see the SPY really just find itself right now. I think she goes down some more.
You're at my level, so we're hitting my level here. So we blew through. We're probably coming down to approach your blue pill line again.
At 380, 278. Yeah.
Yeah.
Let's take a look
It's
at
crazy,
that.
man. These it's a very interesting thing because we'll see people come in and they're like, what's an option? And they'll ask those questions in the streams and they're like, I don't really know what this is. I'm coming testing this out. And then 2 months later, they're like, dude, cross, I just made 10%. This is what's happening. Blah, blah, blah. The growth is absolutely insane. So we're gonna keep doing what we're doing, guys. If you guys are interested in joining us, you guys know where to find us, man.
Yeah. Yeah. We had fun with the stream. And again, guys, never get caught on the wrong side of the trade. And this afternoon, 1348 kept you on the right side. You saw what the levels, you understood when to get out, you saw the bounce, you understood when to get in, you played your levels, you jumped on the train, you jumped off the train, you reversed. We played Uno with Powell today. It's a whole lot of fun. So thank you guys for tuning in. We're going to have some fun actually tomorrow.
One-on-ones.
Yes, tomorrow we get to do the one-on-ones.
Mhm.
All right. So guys, make sure you get your plays ready. Take down your notes, timestamps. Let's rock and roll. Let's make money. We already know that the market is...
It's not looking good.
It's fear factor right now. I love it. It's fear factor. It's fear factor. I love it. All right. As we say, what goes up must come down, and what begins must end. Just like this live stream. So we're signing out, guys. Make sure you check out the links down in the description. Also, link pinned to the top of the comment here. All right. Look at, some are going to go ahead and complain. It was like, oh my God, well, it's $96. I'll tell you what. Right. What would you do if we showed you something that would keep you from losing $250,000 of your portfolio? I mean, we've gotten a lot of guys that have come after the fact. Let's not talk about the money gained, because our thesis here is make sure you don't lose money and you focus on not losing money. Because when you focus on not losing money, then the exact opposite is true. You're making money, right? But don't miss out on the opportunity to protect your portfolio now, because things can and will get worse. And I'm not saying this subjectively. You can look at the chart. This is an objective statement. This is a very valid statement. You got these old men, don't really know what the hell they're doing. Right? If you want everything you work for to be guided by men who don't really give a shit about you, your entire nest egg to be guided by these men, well, then you deserve all the world of hurt that's waiting for you.
You got to put the time in. You got to put the time in and learn.
That's it. Thank you, guys. We love you. We'll see you tomorrow. Wait. On the Discord. Yeah. Wait. Are we gonna do the one-on-ones? Are they gonna be public, STV?
We've been doing them private. We can figure out if we want to do them public or private or not.
Yeah. Well,
I'll be
let
live
the community
tonight
decide.
too for those late night streams too. Bringing them back.
Oh yes, STV is coming back. He's bringing it hot at night with that beautiful view. Yeah, handsome son of a gun. All right, guys, we're signing out now.